Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Good morning, everybody. It is just about 10 o'clock on Tuesday, June 1st. So happy June, happy Tuesday. Hope everybody enjoyed their holiday. I hope you got some restful time. It was quite a busy few days for us. We had a bit of a family emergency with one of our dogs. The big German Shepherd ended up having emergency surgery Thursday. So we couldn't bring him home until yesterday. It's been kind of these animals creep into your lives and your hearts, and it's just like having a family member having these issues. So it's been a crazy few days for us, but here we are, we're back. So I want to wish everybody again a happy June, and let's get started. Remember that these webinars are always recorded. You, however, are muted. There's a question and answer box at the bottom of your Zoom screen. Your chat is disabled, and I think I already said that we're recorded. Let's see. We do have. I think I let you know last week that we're starting our summer office hours. So if you try to reach us after 3 o'clock on Fridays, we're going to be gone for the weekend. I know I look at my emails most of the time over the weekend. So if you need something right away, and if you're a client of ours, of course, you have my mobile number if you need me at any time. We're planning on returning to the office in July. However, I am making some inroads pretty quickly with renovations. So that may be adjusted, but as of now, the plan is that staff and myself will be back in the office for July. I'm going to be very open about and flexible about meeting online, like Zoom meetings, which really are very efficient and easy and just really work well. So, but I'll also be able to meet in person, but we'll have to coordinate those days. So the plan right now is to return to the office in July, but that's subject to change given the potential renovations. Upcoming special webinars are using annuities and retirement planning and Roth conversions. That's next Wednesday at 6:30. That's June 9th. And then we have another one on June 30th at 6:30. That's fiduciary assistance for powers of attorney, trustees, and executors. And then July 21st, we have a third, and that is investment fundamentals. We'll talk about the basics of mutual funds, exchange traded funds, stocks, bonds, cash. We'll give you all the CDs. There's a lot of discussion around TIPS, which are inflation protected securities, treasury inflation protected securities. So we'll probably talk about that. And then our fourth one coming up July 28th. So we're putting 4 of these into 2 months. The reality of the 4% rule. So everyone's heard probably of the 4% rule. We really dig in and talk about what that means for you. And if the 4% rule isn't really just kind of a bogus book and TV selling idea. So today, we're like most days, or all days when we do these, we're going to have a discussion about the markets, just some updates, and then I'm going to have a financial planning tip. Oh, I just realized I didn't turn my light on. Let me fix that. So let me just see if there's any questions before I get started. No, nothing. All right, good. And as my calendar just popped up on my right-hand screen there, it reminded me that, in fact, when you're done here, you'll have an opportunity. When we're done the webinar today, you're going to have an opportunity to schedule time with me if you'd like to. We do have some time in June, about 5 or 6 days that are available for booking. So if you want to have a 50-minute consultation with me, if you're not already a client, you can book that after you log off of this webinar, or after the webinar is done. It should automatically populate on your screen. And today, for the financial planning topic, we're going to talk about HSAs, or health savings accounts, in financial planning. So we talked about using life insurance as a tax benefit for yourself and your heirs last week. And we've certainly talked about Roth IRAs, Roth 401ks, And we talk a little bit about HSAs, but a health savings account, but we're going to explore it more. I'm going to show you some resources that we have for you. And even if you are retired and you're not working anymore, because you have to, there are some qualifications. You can't just open up an HSA if you don't meet the qualifications. And if you're not employed, you're not going to meet those qualifications. But pay attention anyway, because it really might help your kids, grandkids, people who are still working. I know one of the benefits that I hear from clients is that, we have kind of a friends and family opportunity. So if our clients' children, grandchildren have financial questions, they can come to us and we'll help them. We'll give them advice. We'll try to put them on the right track and try to get them started the right way, because one of the things that we always hear is, geez, I wish I would have heard about this, or I would have started this 10 years ago, 20 years ago, whatever it is. All right. So let's talk about the update. So there's a big update this past week that came from the SLOT group. Now, again, just to remind you, I'm one of 400 members of Ed Slot's lead advisor group. And in fact, I'm a part of the master lead advisor group, which simply means I've been there for a while. There was, about a month ago, publication 590B came out from the IRS, and 590B had to do with the 10-year rule that replaced the ability for stretch IRAs. So if you're in my classes a year or two ago, or I guess 2 or 3 years ago, I would stand up and I would talk about stretch IRAs, and I would say at some point stretch IRAs are going to be gone. So stretch IRAs gives the ability for a inherited IRA at the time to be drawn over that beneficiary's lifetime. It was stretched out over that lifetime, and there are some benefits to that. Well, that's gone now. The IRS, the government, wants their money as soon as possible. And in this case, they've changed it now to 10 years. So when this rule first came out, it was the 10-year rule became the new 10-year rule for non-eligible designated beneficiaries. And we'll talk about that in a moment. But what was clear is that those IRA funds for non-eligible designated beneficiary had to be distributed within 10 years. Now, if it followed the 5-year rule type of transaction, that means by December 31st of the 10th year following the year the person passes, right? The person who owned the IRA to begin with passed, and those funds had to be distributed. But then about a month ago, the IRS came out with a publication that said that required minimum distributions had to be taken along that time. So there was a lot of work done, there's a lot of discussion and waiting for clarity from the IRS. So we got some clarity on at least a couple points. There's still an issue hanging out there, but so publication 590B now says that the 10-year rule for about what it now says for the 10-year rule for designated beneficiaries, there are no RMDs in years 1 through 9. So this just came out May 26th. So last Wednesday, I guess it was. So publication 590B now says no RMDs in years 1 through 9 for non-eligible beneficiaries, designated beneficiaries. The only RMD is at the end of the 10-year term. That's when the entire IRA balance must be withdrawn. However, you can take distributions within those 10 years if it works in your plan. So you don't have to wait until the end of that 10 years. You can take them, but there are no requirements to take them. So that settled that. That took about a month or 6 weeks, just to kind of clarify that. Now, eligible designated beneficiaries can still qualify for the stretch IRAs. But if they wish to elect the 10-year rule, they can. So they can only do that if death occurs before the required beginning date, but they can still do that. So what does that mean? So if your spouse passes before age 72 or the required beginning date, then you can still elect that 10-year rule. And spouses and eligible designated beneficiaries have a lot more flexibility. This also means that eligible designated beneficiary who inherits a Roth IRA can elect to use the 10-year rule if they wish. Now that's really helpful because they can keep those funds built up in there for the Roth IRA and maybe have that for legacy or continue to have that grow tax-free. That's because Roth IRAs have no lifetime required minimum distribution for owners. So anyone who dies with a Roth IRA is deemed to have died before the required beginning date. That makes sense. Something coming from the IRS that makes sense. So let's talk about who are eligible designated beneficiaries. Well, they include surviving spouses, minor children of the account owner, disabled individuals, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So let me repeat that. An eligible designated beneficiary is surviving spouses, right? So spouses have a lot of flexibility. They can treat IRAs as their own. They can keep them in an inherited IRA. They can do, depending on when their spouse passes, they can do a 10-year rule, or they can, there's a lot of flexibility there. So surviving spouses, minor children of the account owner, disabled individuals, and there's some definitions around minor children, depending on if you're attending college or not. But just for simplicity, let's just say minor children of the account owner, disabled individuals, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. There's still an outstanding question: when does the 10 years end? Typically, it's this is for minor children. Typically, it's 12/31 of the 10th year after the year of death. There's still some question about the 10 years deadline for minor children, and so we're waiting for some clarity on that. If you have that certain situation, give me a call, schedule a meeting, let me know, and I'll give you some more clarity on that as much as I can. But we're waiting for some clarity from the IRS. Why would an eligible designated beneficiary, if they're able, choose the 10-year rule over a stretch IRA? Well, they could, in fact, then delay any requirement and distribution at all for 10 years. So why might they do that? Well, it just may allow for more creative planning, because again, you can take money out of there, but you don't have to take money out of there. So just alleviating that requirement might be beneficial in financial planning. So don't disregard it. If God forbid something happens, your spouse passes away or someone close to you passes away, remember, do nothing. Don't listen to the custodian. They mess things up all the time. Have a conversation with a qualified person like us, and make sure that you're running through all the different options before you make a decision on how to distribute those funds. Because once a distribution is made, it just can't come back. You can't unbreak that egg. All right, so let me just see if there's any questions before I move on that, because that's a confusing, I know, topic. Okay, very good. So that's the update from the slot program so far, or the best one for this week. There's a lot of them. I maybe get 6 or 8 throughout the week, but some of them are repeats, but that's the best one. Oh. Goodness. All right. It looks like I have the wrong chart for my week. I don't know what happened there. Okay. Well, oh, I know. Did I put it in the wrong place? Well, I apologize, but I have my chart from my markets chart from last week. Let me just stay with me. Let me do a quick search and let me find it. It just came in a moment ago. And it's going to give me a hard time here. Okay. Well, the markets were up slightly last week, so that's good. And it's positive today. It's, we're still at about 11-12% for the year in the overall Dow Jones Industrial Average. I don't have a good perspective on what the bond market did, but just looking at some of our bond funds and some of our bond investments this morning, it seems to be leveling and we're not seeing, we're certainly climbing from the lows that we had in March, April. So that's positive as well, just some stability. So my apologies that I don't have some more deeper information on that. But let's talk about the by the numbers that I get from MFS. This is some really interesting information. So this talks about the SP 500 being up 11.3%, but that was as of the week before the 21st. So again, we closed up about 1.2% over the past week, I think it was, off the top of my head. So they talk about stock performance over the past 20 weeks. Inflation, again, is a big discussion. You remember we talked about it last week, and there's ranges of about 4.5 to 6%. And I've got a really good piece again that came in from Prudential over the I guess it was the end of last week, and I read it over the weekend, and I have some points I want to share with you. But this tip is giving us some history around the consumer price index and inflation. So that measurement, the CPI, Consumer Price Index, was up 9% in 1978. This is not going to shock anybody who lived through the 70s and 80s. 13.3% in 1979, and followed by 12.5% in 1980, and then 8.9% in 81. So I think this is a good look back, because we have different tools that the Fed can use now than we did in the 70s and 80s, and hopefully that helps. But we're pretty far away from 13 and 12, but we're not far away from 8 in certain areas. And we're going to talk about some of the concerns that at least one analyst has around the ebbs and flows of future inflation. But I had to tell you, including myself, there are multiple analysts, and we've been hearing it for many, many months, concerned about inflation and the effect of the markets on inflation, and the spending of the government, inflation, and how the Fed is going to act. Those three things tied together could really be troublesome for the stock and bond markets, really. And a lot of most folks automatically go to bonds for safety, or choose to go to bonds for safety. And having the right bonds is going to be very, very important. So currently there's the number of job openings in the United States has increased by $1.2 million. You're living under a rock if you haven't heard about it already, of the people looking for work. We have landscapers. Somebody over the weekend was telling me that they're advertising $24 an hour for landscapers, and they're not getting people. So that's really surprising. I was talking to a owner of a landscaping company. So that's really surprising. They're having a hard time filling these positions. So that's 1.2 million jobs in the last 2 reported months, meaning that U.S. employers have added 20,441 new job postings each day during February and March last year. The 8.123 million job openings nationwide as of March 31st, 2021 is the highest number recorded in U.S. history. So we have the highest number of open jobs since at the end of March in recorded history. And that's from the Bureau of Labor Statistics. That is just shocking to me. So there's also a lot of spending going on. 59% of U.S. households made a large purchase during the first 4 months of 2021. And that's, of course, January through April, the highest percentage reported in 5 years. Large purchases include furniture, home repairs, and automobiles. And we know that there's a lot of inflation pressure for home repairs and automobiles. I'm hearing that, from different areas, that it's hard to find automobiles. Dealerships are offering more for used autos than they really probably ever have in the past. I don't have any data to back that up, but it sure seems like it. I've had a few friends of mine who have traded in cars early on leases and were shocked and the reason they did it is because they were very surprised at how much money they were getting for those leases. And in fact, sometimes they made a little bit of money on it. So it's really, really surprising. And we're coming into the summer months where gasoline is going to be used. We see gas prices going up around the country. American drivers are projected to use 9 million barrels a day of gasoline during the summer of 2021, up from 7.8 million barrels a day used during the pandemic summer of 2020. Now that surprised me. I expected it to be a lot less last summer, but still $1.2 million or 1.2 million barrel difference is pretty significant daily. That's still down from 9.6 million barrels a day of gasoline used in the summer of 2019. So, and that's from the Energy Information Administration. Total U.S. credit card debt peaked at a record 930 billion as of the end of 2019, pre-pandemic, but has since fallen 17%. So this is positive. Debt has gone down. So that's fallen to 157 billion to 773 billion. Not many loans going bad in the scheme of things. The savings rate has increased a lot too, and this is a concern that analysts have about inflation. A lot of people are holding on to savings and cash, and when that money starts coming back out, they're kind of saying we haven't even seen it yet, right? That we're already seeing inflation, consumer demand much higher, but still people are holding a lot of cash. So the personal savings rate in the U.S. is 21%. The personal savings rate in the U.S. 10 years ago was 5%. So in the same quarter, 2021, 20 years ago to 2001, 5% compared to 21%. Really shocking. And what we talk a lot about, this is an interesting piece of information from the Cato Institute. We talk a lot about rising taxes in the future, and we know we've got this window of probably about 10 years before taxes really start taking off. But there is also a shift, and I see it with my young kids. And the Cato Institute reports that 70% of Americans under the age of 30 believe the distribution of wealth in the United States is unjust. So there really could be a shift of how things are handled and taxed and redistributed in our country. I don't know. 70% of Americans, that's a big number. All right. So let's talk about, let me just pause to see if I have any questions. I don't see any. Oh, there's a question. So Denise asks a really good question here. So for individuals, let me move this screen because it looks funny that I'm reading it there. For individuals investing in an IRA and falling under the 10-year rule, is it better to hold as the estate of John Doe for the benefit of Mary Smith or transferring it into the beneficiary's name? Well, Denise, you're not going to be surprised to hear me say it all depends. It depends on what your situation is, first of all. So if that individual is a spouse, that it might make sense for that spouse to treat that as his or her own. Or it might make sense for that individual, if he or she is a spouse, to have it as an inherited IRA, because like I said, depending on when that person passes, you might have more time before those required minimum distributions trigger. Let's just say that your spouse is 5 years younger than you. You can, and you're 70 years old. Well, now you've delayed those RMDs by, I think that would be 7 years, but that's significant, and it might be beneficial. So it really all depends, and that's a really good point, Denise. If you inherit an IRA, just don't do anything. If God forbid your spouse passes away, someone close to you passes away, and you have funds coming to you, just don't do anything. Contact us. We'll go through your options because it is going to depend on your situation. So I hope that answers your question. And if it doesn't, you know where to find me. Okay, let's talk about, again, a great report, I think, from Robert De Lucia from Prudential. And it's titled A New Inflation Cycle. It's really hard for me not just to read these things to you, but he says the U.S. economy is at an early phase of new inflation cycle that could persist over the next several years. Nothing new there. We've talked about that before. He expects consumer inflation to remain in a generally rising trend in coming years. Again, we've heard that all over. What I liked in this report is that he talked about 3 phases. The current inflation cycle is likely to evolve in 3 phases. The U.S. economy is currently in phase 1. That is a volatile and disorderly response of consumers and businesses to a suddenly reopening economy. So we're shut down during the pandemic. Things are, the workers can't go into work, because of health concerns. Demand is much lower, so there isn't that pressure to get things done. But now we're coming out of that, and we don't have that stockpile that we would normally have. So now we're trying to keep up with things. So the reopening of the economy is a shock to both supply and demand, but should be viewed as a one-time event. Supply chains were disrupted during the pandemic. This is what I was just talking about, causing many firms to have an insufficient supply of materials, components, and workers to rebuild inventories, of course. So we had this discussion during our school board discussion because we're building and doing renovations to the tune of about $54 million. And one of the driving factors was, things have gone up so much, building materials, that it really could change the cost of this. And we usually work in about a 4% inflation cost for building materials and labor. But I believe it has to ebb. It has to reduce at some point, because I think that this type of growth is unsustainable. At some point, people are going to back off and say, "I'm not going to build." Maybe not the big projects where we have to continue to, like school districts and government. There's a lot of money coming out for infrastructure. Maybe that'll keep it high and growing. That's a concern also, but just from an individual consumer point of view, I think people are going to hit the brakes at some point and say, well, wait a minute. I'm a little concerned about these rising prices, and I want to, I really don't need to do that addition or, redo that bathroom, whatever the situation is. So phase one could persist for the next 4 to 6 months before logistics of supply and demand adjust. Currently at a rate of 3%. That's a little low. Currently at a rate of 3%, the consumer price index could rise to a peak annual of 4 to 5% during the summer months. That we're really there already. The first phase, and that's really high compared to what we're used to. We're used to, in my financial models, financial planning models, we've been at 2.43 for some time, and I've often heard people say, well, geez, that seems high. But it's probably something we need to adjust relatively soon and go up into the 3s, 3.5. The first phase should evolve into another interim phase, which is expected to be a period of selling, price consolidation, stability. The second phase of inflation should be a reversal of the spike in consumer prices expected during the spring and summer months. So that the second phase, he's saying, is a reversal of that growth. So maybe probably just a steadying. I'm not sure if we're going to see a drop, but a steadying. The third phase is far more worrisome than the phase one spike, because the expected rise in inflation at that time would be sustainable. The result of enduring fundamental forces pertaining to fiscal policy and monetary policy excesses, that just means the federal government spending money, and then the Fed trying to manage the inflation and interest rates along with that. Extremes in government policy almost always precede a period of rising inflation, and whether you agree with it or not, you have to admit that these are extremes as far as spending that we're seeing from the government. Whether it's the past spending we saw with the COVID stimulus, or these the spending proposals that are presented by President Biden. So money supply has increased at a 24% rate over the past year, the fastest pace since the early 40s. An unprecedented divergence between the expansion in money and production of goods and services greatly increases the odds of a sustained inflation cycle. So that's a really fancy way of saying what I just said. Rapid government spending also provides fuel for faster aggregate spending. That's what I said as well. The government with the infrastructure plan and spending money on all these programs also causing inflation. Wages are also likely to increase at an accelerating pace. Remember the landscaper I was talking about, paying $20, $25 an hour, $24 an hour, still not able to fill these positions. A combination of strong demand for labor and a shortage of skilled workers should exert upward pressure on wages beginning in 2022. Okay, let me just end it with this. For this report, history teaches that stocks decline while inflation is an accelerating trend. but eventually appreciate in value once the rate of inflation is in retreat and the Fed has begun to ease monetary conditions. In the long term, common stocks can be an effective hedge against inflation. So let me read that again. History teaches that stocks decline while inflation is an accelerating trend. So if we're seeing, and everybody's talking about inflation accelerating, whether it's over the next 4 months, 6 months, or 4 5 years, and we're expecting stocks to decline, doesn't make sense to say pull everything out and set it aside in cash. Well, not necessarily, because you've got to have that plan in place. So how do we manage all these things? It comes back to asset allocation, principal protection, account segmentation. So there is some you're going to want to make more conservative, and that's the money that you're going to need to spend in the first segment, right? The first 3, 4, 5 years, whatever your segment is. Then you got your second segment you can be more aggressive with, so on, so on. It's important to know these things. It's certainly important for us to be intimately aware of them and understanding them as we're developing your financial plans and developing your portfolios. But is it something you should get hung up on? It depends. You might be the person that really loves this kind of information. I hope it's helpful to you. You might also be the kind of person, like my wife says, I want to know the outcome. I don't want to know everything that goes into every piece of it. The reason I share these things with you is not to concern you. It's just to share what's going on in the overall environment, so you know what to expect. Because we're certainly going to see volatility. The screens. I was going to say the screen's all green right now, but the Nasdaq's down. So the last time I turned around, it was all green. Now we have some red up there, and that's how it's going to be. But asset allocation, principal protection, account segmentation, they're the 3 keys to keeping your portfolio where it needs to be, so you can manage all these whipsaws, the craziness that happens no matter what. I've been doing this for over 20 years now, and there's always something. There's always going to be something. You've got to manage it for your needs, not a 4% rule, not like a rule of thumb, but for what your needs are. So just remember that. Okay, I'll get off my soapbox. There's my first trust. And what did I say? Okay, that's crazy. So 1.2%, somehow that got to the bottom, and it should be up top. 1.2%, it was up, the S&P 500 was up last week for 12.6% for the year. I think that's exactly what I said. And it looks like the overall major indices were positive, including most of the bonds for the week. Yep. So that's good. Okay, let's talk about health savings accounts. So I'm going to take you to our website. So I'm going to share my screen with you. So you should see my screen in front of you, or my website in front of you, our Out of Our Wealth Management website. If you see that, please raise your hand before I move on. Okay, I've shared this with you before, but if you go in, there's a lot of information here. But if you go to the slot corner, I'm just going to direct you to these forms at the bottom, these charts, and I use these charts a lot. And I'm sure here's a picture of me and Ed, and there's some video. Ed's a funny guy. I was watching a video. I guess it was this morning, maybe last night, with the update that we were just talking about, the 10-year distribution rule. And he's just genuinely a funny guy. But we've got some tax planning guides. You can download these here. And I get notification when you folks download them. So I see that's happening. So that's good. I want you to use these things. So we're going to talk about health savings accounts. So this is a really good resource. You can go here again. You can download. You just got to put in your email address, and you'll get it sent right to you. So let me go back. But this is a really good guide. Now I'll tell you that Fidelity put this out in May. This is a really good resource too. So you'll see just May 6th of this year, 5 ways HSAs can fortify your retirement. Folks, all I did was I Googled HSAs during retirement or HSAs after 65. And there are some reports that came up, but this was the most recent, right? Because you want to make sure you've got the most recent information. And this is from Fidelity, and it's good information. But the chart here just kind of gives it all in one place. So what is an HSA, health savings account? Must be enrolled in a high deductible health plan, So I think the high deductible health plan has to be at least $1,200. So you got it. Your deductible has to be at least $1,200. And that's probably down here. No, it's not there, but you can find that, which is really small. My deductible is much bigger than that, but you've got to have a high deductible health plan. Now, again, this might not apply to you because you may not be working, or you may not have a high deductible plan, but many, I'd say most people probably have high deductible plans now. So fundamentally, the HSA is really another tax-free, potentially tax-free way to grow your money, because you can contribute. Oh, here's our minimum deductible. So you can contribute in 2021 if you're under age 55 and it's just you, $3,600 a year. If you're over 55 and it's just you, you can deduct. You can contribute. Decide to say deduct, and that's also a deduction. $4,600 a year. Well, for a family, you're at $7,200, and if you're over 55, $8,200. So these are pretty good numbers. Now, the thing is that you get a tax deduction. This is different than a Roth IRA, because if you're able to contribute to a Roth IRA, then these are after-tax dollars. Well, here you get a tax deduction for this $7,200, $4,600, or $8,200 if you're over 55. So you get a tax deduction. If you use the funds for qualified medical expenses, the funds come out tax-free. Well, who isn't going to have qualified medical expenses after they retire? That's one of the biggest concerns we have. And you can use them for Medicare premiums, supplemental premiums, things like that. What I recommend for most people is don't spend your health savings. Don't use it like a flexible savings account. Remember the flexible savings account? Many of you may still have them. I had one when I worked at Wells Fargo, Wachovia, and it was a use it or lose it situation. So we all used them. That was the habit, right? You'd buy contact lenses, you'd over-the-counter drug, whatever worked, you'd want to put that money in and it comes back out tax-free. Try to shift your thinking differently for an HSA. Build that up for retirement, because that's another way to save in that tax-free bucket. And you can invest these funds. Don't just let them sit in cash. Find a custodian that allows you to invest the funds. I have my funds invested. I maximize contributions every year, and I don't use them because I know I'm going to need them during retirement, and I have it invested appropriately for me. Invested appropriately for you, probably with a long range, the idea that this is going to be longer term money, but you may want to segment this as well. So take advantage of the HSAs if you have them. Here are some benefits here. So control, you owned and controlled by the individual, not the employer. If a spouse, what happens when an HSA owner dies? So spouse beneficiary automatically treated as new HSA owner. So husband passes, wife receives the HSA. Non-spouse beneficiary must include HSA value at death as taxable income, but there is no penalty. If you take distributions, tax-free for qualified medical expenses of the individual, spouse, or dependent, distributions not used for qualified medical expenses are taxable as ordinary income, plus a 20% penalty due to death, disability, or age 65 plus. Some people think that you can use an HSA for anything after age 65, and you can. There's no penalty on those distributions. But there will be tax if they're non-qualified medical. If they're not qualified medical expenses. So yes, you can take distributions for anything and you won't be penalized. But if they're not for qualified medical expenses after 65, you will pay tax on it. So again, best to save that for your qualified medical expenses, in my opinion. Employee individual contributions, tax deductible is an above the line deduction that reduces your adjusted gross income, regardless of the individual's tax filing status or income. I hope you're seeing that. Remember, a Roth IRA has limitations. Then you can find that that chart on here as well. That's right here. These are the phase outs for Roth IRAs. So if you're married filing jointly and you make more than $280,000 adjusted gross income, then you can't contribute to a Roth IRA. Here, what the HSA chart is showing you, and it's accurate. Where did it go? Regardless of individual's tax filing status or income. So there is no limitation on there. Employer contributions, tax deductible to employer and must be comparable. Employees do not include employer HSA contributions as income. Investment gains are tax-free if used for qualified medical expenses. Remember that this is something that I've heard from really people who pay attention, who understand. They say, I can use this for anything. Well, you can after age 65, but you're going to pay tax if they're not for qualified medical expenses. Portability between HSAs. HSA funds can be rolled over or transferred to another HSA. Once per year rule and 60-day rule applies to rollovers. Pay attention to that. This once per year rule and 60-day rule can get people caught up, and you'd hate to see all of a sudden something you built up as tax-free now become a taxable issue. If you need more information on that, reach out to me. Portability from an IRA. IRA funds cannot be rolled over or transferred to an HSA. There's a one-time exemption for that. Exception, for a qualified HSA funding distribution, and that's covered below. HSA funds can never be rolled over to an IRA. It can't go the other way. I don't know why you'd want to do that. So, because that would make it a tax deferred instead of tax free. A qualified funding distribution is a tax-free direct rollover from an IRA to an HSA. It's one-time only transfer from an IRA. It's limited to an individual's maximum HSA contribution for the year. Only pre-tax IRA funds can be transferred. That's an exception to the pro rata rule. So if you have $7,000, $7,100, or $7,200, that's what it is this year, right? Yeah, $7,200 in pre-tax money in your IRA, and you're tired of tracking it, and you just want to get it over and put it into your HSA. You can do that. That's one time. Does not apply to ongoing simple or SEP IRAs. After that qualified distribution, individual must remain HSA eligible for a 1-year testing period to avoid taxes and penalties. So what that's trying to avoid is, I'm going to take $7,200 out of my IRA, put it into an HSA, and then I'm going to close down that HSA. And now I've kind of washed it of the tax. They're savvy, and they're not going to let you do that. And use it or lose it rule does not apply to the HSA. So they can, while you can't put a lot of money aside, it's still over time. I'm surprised at what mine has grown to, and people are surprised as well. I hear it from people who have been doing this, especially if you're investing the funds, as I believe you should. If you need some guidance on that, that's something we help with financial planning. We don't have a mechanism right now internally to manage the HSAs for you, but we'll certainly help educate you and make the right decisions about how to allocate those funds. So that's more good information on our website. Again, you can download this just using this download button. You can look at the RMD tables if that's applying to you. Again, there's tax tables here, contribution limits, a lot of good information on the website. Medicare information, and we're just mid 2021, so we'll get these updated. Okay. I don't see any questions. I'm going to end there if I don't have any questions. It was really great seeing you all. I hope you really had a great weekend again, as we discussed. And I look forward to seeing you next Tuesday at 10 o'clock, and then again next Wednesday. If you need to schedule time with me, please take time to do so. And if you have any questions, reach out to us. Have a great week. Thank you. Hello again. I hope you enjoyed the video, and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.